Good morning, everyone. I am Paul Schmidt, the chairman of BakerHostetler and the former chairman of the tax group at Baker. I'll be one of your moderators for this webinar. I am joined by my partner and good friend, Jeff Paravano, who's the managing partner of our DC office and chair of our firm-wide tax group. First, thank you all for joining us. These are really unprecedented times, and things are changing on a daily, if not hourly, basis. So first and foremost, we at BakerHostetler sincerely hope that you and your family and loved ones are all safe and well. We're here to help you in any way that we can. So, on Friday, the President signed the $2 trillion CARES Act. This is the third, but not likely last, phase in a series of stimulus bills. Our teams have been assisting clients around the country with really novel operating issues during this pandemic crisis. Our tax and labor and employment groups have been particularly active in assisting businesses with economic and workforce issues. We appreciate this opportunity to discuss selected issues with you today and look forward to the days when things start to return to normal. So with that, let me turn it over to my co-moderator, Jeff Paravano, who will introduce our speakers and today's agenda. Jeff?
Thanks, Paul, and thanks to each of you for joining us today. We had over 1,000 registrants for this webinar, and I see folks are still dialing in. As Paul noted, my name is Jeff Paravano. I chair our tax group and serve as managing partner of BakerHostetler's DC office. In these difficult times, I have to say our federal government has provided a wonderful gift to all of us in the form of the CARES Act. The complexity is fascinating. It's like a 1,000-piece jigsaw puzzle for lawyers and accountants and clients. And you better know a lot about rules outside of the CARES Act, like BEAT and GILTI and FDII, before making decisions about which CARES Act provisions to take advantage of and which ones to pass on or ignore. The CARES Act makes hundreds of billions of dollars available to businesses in the form of such items as grants, tax credits, loans, payment deferrals, loss carrybacks. The list goes on and on. For example, there is $32 billion of grants available to air carriers and certain contractors. Treasury published guidelines this morning, and the recommended application deadline is this Friday, April 3rd. So things are moving very quickly, and there's billions and tens of billions and hundreds of billions in play, and it's all moving very fast. Loans are available to large companies, to mid-sized companies, to small businesses. Some loans are forgiven if certain conditions are met. Some of the relief provisions, like the Paycheck Protection Program and the Employee Retention Credit, require some level of employee retention, whereas other items, like the Family's First Payroll Tax Credit for sick and family leave, is available more broadly. And many provisions interact with one another, preventing certain types of double dipping, but allowing for other types of double dipping. What's been most interesting, I think, in recent days, we have a COVID-19 SWAT team that we'll introduce near the end of the seminar, and we've had SWAT team members on the phone with relationship partners and clients, evaluating available benefits with each client based on their particular facts and their industries. And what we're finding is many clients who have workers who cannot work from home and who are closed down, they're determining in many cases that the workforce retention loans and the credits are not sufficient to cover their required employment retention costs, and they're instead looking to furlough some workers for now into some of the expanded state unemployment insurance programs, and hoping to take advantage of some of these provisions to save the business and to get them back to work very quickly. Contrast that with clients whose employees are able to work from home, and in many cases they're finding that the employee retention tax credit and certain other benefits can be just what they need to help with some retention as their revenues decline. So we have a terrific group of speakers today. John Lair, Michelle Hervey, Seth Hanft, Jenny Mills, and Kevin Shaughnessy. We've got a lot of tax and labor and employment and business lawyers working on these issues and presenting some of what they've analyzed to you today. In less than an hour, they'll answer questions about tax, employee benefits, and employment issues. We're also happy to take questions from those of you participating. You can type your questions in on your computer, and we'll address as many of those as we can near the end of the webinar. So with that, let's start with John Lair and some tax issues. John, what changes did the CARES Act make regarding the use of NOLs?
So Jeff, the CARES Act makes two significant changes with respect to the use of NOLs. First, it temporarily repeals the 80% taxable income limitation with respect to NOL deductions that was enacted at the end of 2017 as part of the Tax Cuts and Jobs Act. Second, it also allows taxpayers to carry back NOLs arising in a taxable year beginning after December 31, 2017 and before January 1, 2021 to offset taxable income in the preceding 5 taxable years preceding the taxable year of the loss. By way of background, for taxable years beginning after December 31, 17, the Tax Cuts and Jobs Act basically modified Section 172 to both limit a taxpayer's ability to claim a net operating loss deduction to 80% of its taxable income for the taxable year, and also to eliminate a taxpayer's ability to carry back net operating losses to offset taxable income in prior taxable years. There are a few limited exceptions to the carryback rule. Those specifically are involved in the farming and insurance company businesses. The CARES Act generally reverses those changes for a taxpayer's 2018, 2019, and 2020 taxable years. In particular, as I said before, for taxable years beginning before January 1, 2021, the 80% taxable income limitation does not apply, and a taxpayer's net operating losses can fully offset its taxable income for the year. For taxable years beginning after December 31, 2020, the 80% taxable income limitation is reinstated, and the new law makes it clear that certain deductions under Section 172, so for net operating losses, under Section 199 Cap A for qualified business income, and under Section 250 for FDII and GILTI, are specifically not taken into account in computing taxable income. In addition, as I said before, the Act now allows a taxpayer to carry back a net operating loss arising in a taxable year beginning after December 31, 2017, and before January 1, 2021, to each of the 5 taxable years preceding the taxable year of the loss to offset taxable income. For example, a calendar year taxpayer with a 2020 loss can now carry it back to the 2015 taxable year. One thing to note is that given other deduction items that have been retroactive, that have been given retroactive effective dates under the CARES Act, taxpayers need to evaluate applicable carryback periods if you find that you're in a loss position, maybe for 2018 or 2019. A few additional items are noteworthy. First, the CARES Act contains special NOL carryback rules applicable to REITs and life insurance companies. Second, for taxpayers that had a repatriation tax inclusion under Section 965, if the taxpayer carries back a net operating loss to a year in which they had an inclusion under 965, they are treated as if they made an election under Section 965N for that year, meaning that any 965 inclusion will not be taken into account in determining the amount of taxable income, which may be reduced by the net operating loss carryback. A taxpayer may elect to exclude a taxable year containing a 965 inclusion from its carryback period. If a taxpayer makes the election to waive the carryback with respect to a net operating loss arising in a taxable year beginning in 2018 or 2019, it must make the election by the due dates, including extensions for filing its return for the first taxable year ending after the date of the Act's enactment. The application of this specific rule as it relates to 965 can be a little complicated, and we're happy to discuss this further with you under your particular facts. A few final items to note here. First, the U.S. federal income tax rates were changed at the end of 2017 as part of the Tax Cuts and Jobs Act. The Act allows taxpayers to carry back net operating losses to taxable years beginning prior to January 1, 2018, to utilize the higher tax rates that apply to such taxable years, making the NOL carryback to earlier years even more valuable. Second, for those that have engaged in mergers and acquisitions over the last 5 years, those particular agreements need to be considered when thinking about the carryback rule, because there may be some additional items to take into account, including a requirement to provide sellers with a portion of a tax refund amount that's claimed, and the like. So just be careful there. Finally, the other thing to note with all of this, we're talking about federal tax rules, and there could be state implications as well. And so I would say to carefully consider the state tax implications along with all of this.
Thanks, John. That's really good news for NOL taxpayers to be able to carry these back, and probably is a great source of potential cash for entities that are facing liquidity issues. So how can a business quickly claim a refund from the federal government for carrying back an NOL?
So to claim a carryback, corporate taxpayers generally file an IRS Form 1139. So it's a corporation application for tentative refund. And individual taxpayers, including estates and trusts, can file an IRS Form 1045, an application for tentative refund. In general, these forms must be filed on or after the date the return for the net operating loss year is filed, and within 12 months after that taxable year. I would say pay attention to special timing rules for filing these claims. You also need to consider whether to file an amended return as well. Along with kind of everything else, the government is working on additional guidance with respect to a number of outstanding questions. And so I would also encourage everybody to pay attention to guidance as it comes out, because it is likely that some of these questions will also be answered in that guidance in the coming days ahead.
Thanks, John. It's Jeff. In addition to what the CARES Act does with respect to NOLs, are there other changes made to the use of losses by taxpayers?
Jeff, there are. The Act temporarily defers the application of Section 461L of the tax code, which limits a non-corporate taxpayer, so a pass-through entity, an individual, a trust, or estate. It limits their excess business loss deductions. Given the deferral as part of the CARES Act to the application of 461L, it will now apply to only those taxable years beginning after December 31, 2020. Recall that 461L was enacted as part of the Tax Cuts and Jobs Act at the end of 2017 and provides that a non-corporate taxpayer cannot deduct an excess business loss, and that any such loss is treated as a net operating loss carryover under Section 172. For this purpose, an excess business loss generally means the excess of a taxpayer's aggregate trade or business-related deductions for a taxable year over its aggregate trade or business-related income for that taxable year, plus either $250,000 or $500,000, depending upon a particular taxpayer's set of circumstances. In addition to relaxing this loss limitation rule, the CARES Act does make certain amendments relating to the computation of excess business losses, including specifying that items attributable to a trade or business of performing services as an employee are not taken into account, and that losses from the sale or exchange of capital assets also are not taken into account in determining the amount of the excess business loss. Again, as I said before, the loss limitation rule under 461L, as amended, is restored for taxable years beginning on or after January 1, 2021, and for taxable years beginning before January 1, 2026.
So, John, it's Paul again. You're going to be able to tell that I'm very interested in how to get a hold of these refunds. So how would a taxpayer request a refund from the use of the excess business losses that previously couldn't be utilized for 2018?
So at this point, it's not entirely clear, and appears that a taxpayer must file an amended return to request relief with respect to these losses previously disallowed under 461L. An individual taxpayer generally may amend a prior year's return by filing a 1040X within 3 years of the date the original return was filed, or within 2 years of the date the tax was paid, whichever is later. It really is especially unclear how a partnership and its partners would obtain relief, because under the new partnership audit rules, which are effective for taxable years beginning in 2018, a partnership is not permitted to file an amended return, but rather must utilize the administrative adjustment request process. Again, as I mentioned before, it's likely that additional guidance on this item will be issued in the coming days ahead.
John, let's switch from losses to growth. Given the current state of the economy, is there a tax reason that my company should still be considering making capital expenditures in 2020?
Jeff, that's a great question. And I know it's a question on everybody's minds at this point. So one thing the CARES Act does, it actually includes a technical correction to Section 168K that makes qualified improvement property eligible for 100% bonus depreciation if placed in service before January 1, 2023. For qualified improvement property placed in service after December 31, 2022, the available bonus depreciation is reduced by 20% per year annually thereafter through 2026. Recall that qualified improvement property generally includes any improvement to the interior of a building placed in service after the building was first placed in service, but excludes enlargements, elevators, escalators, and improvements to the internal structural framework of the building. Prior to the enactment of the Tax Cuts and Jobs Act, certain categories of qualified leasehold improvement property, qualified retail improvement property, and qualified restaurant property that would otherwise be depreciable under the general applicable 39-year recovery period for non-residential real property were designated as 15-year property under 168E. Also, qualified improvement property was eligible for a 50% bonus depreciation in the year in which it was placed in service under 168K. The Tax Cuts and Jobs Act attempted to streamline these depreciation incentives by eliminating the separate categories of qualified leasehold improvement property, qualified retail improvement property, and qualified restaurant improvement property, and including them all within the umbrella of qualified improvement property, which is supposed to be designated as 15-year property and therefore eligible for bonus depreciation under 168K2. However, through a technical drafting error, the Tax Cuts and Jobs Act eliminated the separate definitions of qualified leasehold improvement property, qualified retail improvement property, and qualified restaurant improvement property, but failed to assign a 15-year recovery period to qualified improvement property. The CARES Act basically corrects this, and the correction is effective as if the Tax Cuts and Jobs Act drafting error had not occurred. So therefore, it's effective for assets placed in service after December 31, 2017. So to answer your question, Jeff, through all of this, effectively this fix provides a tax incentive, a tax deduction for taxpayers with respect to qualified improvement property that they're available to take in 2018 and in 2019 and certainly in 2020. So it does provide a tax incentive for continuing projects with respect to qualified improvement property.
So John, as the CARES Act is retroactive in the way it modified qualified improvement property in the expensing rule, what now can be done to change a tax return position for a business that it originally took in 2018?
Right. So similar to my other comments, Paul, I think at this point you would need to file an amended return for 2018 unless we have additional guidance that tells us to do something otherwise. For 2019, most of those returns, maybe all of them, have not yet been filed. So certainly you can adjust what you do with respect to 2019 on that return. The other thing that I think taxpayers need to consider is certainly, their 2020 tax provisions are certainly in flux at this point. But there will need to be some thought given to qualified improvement property and how it actually is taken into account on the 2020 tax provision, especially if it's taken as a full deduction in 2018 or 2019.
Thanks, John. It's Jeff again. Let's start by let's move on to asking Michelle Hervey some questions. Michelle, how does the CARES Act impact taxpayers' ability to deduct business interest expense?
Thanks, Jeff. By way of background, the TCJA added Section 163J limitation, which generally limits the deductibility of business interest expense to the sum of business interest income, floor plan financing interest, and 30% of the taxpayer's adjusted taxable income, or ATI. Now, ATI is generally EBITDA, although for tax years after 2021, it is reduced to EBIT. Now, the CARES Act raised this 30% threshold to 50% for both 2019 and 2020 tax years, although taxpayers can elect not to have the increase apply. Taxpayers can also elect to use their 2019 ATI for purposes of calculating their limitation for 2020. So as many taxpayers are still in the process of preparing their 2019 returns, they should be sure to pay special attention to any levers which may impact ATI. Also, taxpayers subject to BEAT may determine that they are better off electing to forego the 50% limitation in favor of continuing to apply 30%. Now, as John mentioned, many real property trader businesses opted to forego bonus depreciation and apply the longer class lives of the alternative depreciation system to avoid application of this interest limitation, especially because of the QIP, or Qualified Improvement Property, error that John mentioned. Because this real property business election is irrevocable, targeted IRS guidance will be necessary for taxpayers to undo their decision to elect real property trader business. Finally, I want to point out that we are still waiting on final regulations under the TCJA. The contents of the second batch of 163J proposed regulations remain a mystery, although OIRA completed its review on March 20th prior to the CARES Act revisions to the statute. In fact, there was wide speculation that these regulations would be released by today. It is unclear whether or how this legislative change will impact release of the regulations.
Thank you, Michelle. So does the increase in the deductibility of business interest extend to partnerships?
Yes and no, Paul. The mechanics are a little different for partnerships. The business interest limitation is applied at the partnership level, but then any excess business interest is allocated to the partners. Although the CARES Act increase from 30 to 50% does not apply to partnerships, the Act does tweak the process a bit to accelerate deductibility of excess business interest at the partner level. The excess business interest allocated to partners, that is, the amount that exceeds the 30% ATI threshold, is bifurcated. Half of the excess business interest will be treated as paid or accrued in 2020 and therefore deductible by the partner without regard to any limitation. The remainder of the excess business interest allocated to the partner is subject to existing limitations, which generally means that it's carried forward until a later year when the partner receives an allocation of excess taxable income or excess business interest income from the partnership.
Thanks, Michelle. What businesses qualify for the employee retention tax credit?
So Jeff, the employee retention credit is available to businesses, including tax exempts carrying on a trader business, who retain employees despite adverse impacts of the current crisis. The refundable credit is equal to 50% of qualified wages paid between March 13th and December 31st of this year, up to a maximum of $10,000, meaning the credit tops out at $5,000 per employee. Qualifying wages must be paid either during a government shutdown order or, for taxable employers, during a significant decline in business. The shutdown order includes both suspension and reductions in business activity due to an order by a government authority. A significant decline is measured based on the employer's gross receipts relative to the same quarter in the prior year. The period starts when gross receipts decline by at least 50%, and it lasts until a quarter when receipts are 80% or more relative to the prior year. Businesses with 100 or fewer FTE employees are eligible for this credit regardless of whether the employee is providing services during the impacted period. However, an employer with 100 or more employees can only include wages paid to employees who are not providing services due to the shutdown or decline. Members of a Section 52 control group or a Section 414 affiliated service group are treated as a single employer for this purpose.
So, Michelle, how does the employee retention tax credit you just described differ from the payroll credit for sick and family leave?
So the payroll credit for COVID-related sick and family leave was included in the Families First Act enacted earlier this month, and it's 100% offset of wages paid. So it's twice as much as the retention credit, but it applies only to the sick and family leave pay mandated under Families First. In other words, it's not available unless the employee has a COVID illness or is on leave because he or she is providing care, and it's only available to employers covered under the Family First leave provisions, which generally is limited to those with fewer than 500 employees. The retention credit is more broadly available to larger employers. However, the CARES Act does expand the administration of the sick and family leave credits by specifically allowing advance refunding. Through this process, if the credits exceed an employer's Social Security tax liability, the employer can apply for an immediate refund. And the IRS has promised guidance allowing employers to use employee withholdings, including income tax withholdings, for this purpose.
Michelle, if my business isn't shut down or distressed, can I still take advantage of the payroll tax deferral?
Yes. The payroll tax deferral, which allows employers and self-employed individuals to delay deposit of the employer portion of Social Security taxes, contains very few restrictions on availability. For taxes incurred from the date of enactment through the end of this year, employers can delay deposit of 50% until the end of 2021, with the remainder deposited at the end of 2022. Now, you'll note that I said very few and not no restrictions on the deferral. One of the cornerstones of the CARES Act is the $349 billion SBA loan program, which offers favorable loans based primarily on payroll and includes partial forgiveness for up to 8 weeks of operating expenses, depending upon your employee retention levels. Taxpayers who receive these loans are ineligible for the employee retention credit, and those who have loan amounts forgiven cannot take advantage of the payroll tax deferral. Qualifying employers who are weighing the benefits of the Paycheck Protection loans against the retention credit may find their decision depends largely on their compensation levels. Those with higher paid employees will likely prefer the loan forgiveness. Finally, although receipt of a Paycheck Protection loan does not reduce the amount of credit for COVID-related sick and family leave, receipt of these credits will reduce the employer's total payroll costs, which are the primary driver in determining the amount of the loan.
Great. Thank you, Michelle. And we'll get a little bit later in the program to the Paycheck Protection Program a bit and how to measure whether you have fewer than 500 employees, and in certain industries, there's a waiver of that. In other cases, under the SBA provisions, they actually put unrelated companies together if they're owned by VCs or others. But let's move on at this time to talk about some employee benefit issues. We have Seth Hanst and Jenny Mills to deal with those. And we'll start with a question for Seth. Seth, does the CARES Act provide employers with additional distribution or loan options for employees that may be impacted by COVID-19?
Yes, it does, Jeff. So the CARES Act provides employers with a few different options for loosening retirement plan distribution and loan rules. And I think it's important to note that I said options because it appears that employers are free to decide whether to add these features to their plans or not. And they may have potential flexibility to tailor the options so long as they don't exceed the bounds of the CARES Act requirements. So the first new option is a special distribution referred to under the CARES Act as a coronavirus-related distribution. This distribution could be made available to participants in tax-qualified retirement plans that fall into one of three categories. The first category would be someone who's diagnosed with COVID-19 themselves. The second category is an employee whose spouse or dependent is diagnosed with COVID-19. And the third category is an employee who experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, having hours reduced, being unable to work due to a lack of child care, the closing or reduction of hours of a business owned and operated by that individual, or other factors as determined by the Treasury Secretary. It's important to note that plan administrators they do have the ability to rely on the employee's certification that they meet one of those conditions. That's a little bit different than hardship withdrawals, where a plan administrator might need to verify that a hardship exists in order to trigger one of those types of distributions. Here, an employee certification is enough. Eligible employees would be entitled to take one or more distributions from their plans, so long as the aggregate amount of the distributions from all plans do not exceed $100,000. The distributions wouldn't be subject to the 10% early withdrawal penalty that typically applies to early distributions. And there's also some tax relief involved here too. Participants who take these distributions would have the ability to repay the plan over the 3-year period beginning on the day after the distribution was taken. Any amounts repaid are then treated as eligible rollover distributions so that they would not be taxable to the individual. Amounts that are not repaid have to be included in gross income, although the recognition of income can be spread out over the 3-year period following the distribution. And the one last thing to note about these coronavirus-related distributions is that they're only available during the 2020 calendar year, so this is a temporary distribution option. I also mentioned that there's loan relief. So there's loan relief in 2 forms under the CARES Act, both of which would be available to the same 3 categories of individuals who would qualify for a coronavirus-related distribution. For those that do qualify, during the 180-day period following the enactment of the CARES Act, the plan loan limit is increased to the lesser of $100,000 or 100% of the present value of the non-forfeitable accrued benefit of the employee under the plan. This is an increase to the current limit, which is the lesser of $50,000 or 50% of the participant's accrued benefit. Qualifying individuals are also entitled to delay for 1 year any plan loan repayments that come due through the end of the 2020 calendar year. Any subsequent repayments have to be adjusted to reflect the delay in the due date and any interest accrued during the delay. And any delay would be disregarded for purposes of determining if the loan is repaid within a 5-year period.
Seth, Paul here. Does the CARES Act provide employees with any relief from the 2020 required minimum distributions?
It does, Paul. So the CARES Act provides a waiver of required minimum distributions that are to be made in 2020, and that includes those that would be made to individuals whose required beginning date is in 2020 because they reached age 70 and a half in 2019. This relief, this RMD relief, generally applies to qualified defined contribution plans like 401k plans and 403b plans, as well as governmental sponsored 457b plans. Note I said governmental sponsored, it does not apply to nonprofit sponsored 457b plans. And the relief also applies with respect to IRAs. This relief is similar to the relief provided in response to the 2009 economic downturn. Unlike with the special distribution and loan rules, this RMD change does appear to be mandatory. So employees are given the right to do this. It's also important to note that with respect to all of these changes I've discussed, the new distribution loan rules and the RMD rules, plan sponsors have time to amend their plans to the extent they adopt the changes. Plan sponsors of non-governmental plans have until the end of the plan year beginning on or after January 1, 2022 to adopt a retroactive amendment to reflect these changes. Governmental plans have an additional 2 years, so by the end of the plan year starting after January 1, 2024.
Thanks, Seth. It's Jeff. That's incredibly valuable not to have to take required minimum distributions during this time of market volatility. How about going the other way? Does the CARES Act provide employers with any funding relief for money going into defined benefit plans?
Yes, and this is a question we've been asked quite a bit. The CARES Act provides companies with cash flow concerns with additional time to meet their single employer plan funding obligations by delaying the due date for minimum required contributions that would otherwise be due during 2020 until January 1st, 2021. At that point, the 2020 contributions plus interest would be due. The interest accrues from the original due date to the actual payment date using the effective rate of interest for the plan year, which includes the payment date. The CARES Act also provides defined benefit pension plan sponsors with the option to use the plan's funded status for the last plan year ending before January 1st, 2020, for purposes of determining the funding-based benefit limitations under Code Section 436 for plan years that include calendar year 2020. This provision should enable plan sponsors to avoid the restrictions on future benefit accruals and on distributions and optional forms under Code Section 436, where a plan has what appears to be a potentially inevitable decline in funding status resulting from the market downturn tied to this pandemic.
Thank you, Seth. That's very, very helpful. Let's turn now for a minute to Jenny Mills and some of the health plan questions. So, Jenny, what are employers required or frankly permitted to do under the CARES Act group health plan rules?
Thanks, Paul. First, I'd like to go over what is required of group health plans under the CARES and Families First Act. Under these acts, all group health plans, both insured and self-funded, will be required to cover all diagnostic testing and costs, including physician and facility costs and telemedicine services related to COVID-19, and these all must be covered at 100%. This includes high deductible health plans that normally would not be able to cover diagnostic testing prior to meeting the deductible. However, because the Act requires this coverage, a high deductible health plan must provide first dollar coverage for this testing. If the plan has a negotiated rate, this would be at the negotiated rate, or if there is not such a negotiated rate, the cash price, which will be listed by the provider on a public website, or the plan can try to negotiate a rate with the provider. Second, plans must cover all qualifying coronavirus preventive services, which includes items, services, and immunizations that are meant to prevent or mitigate COVID-19 that are either evidence-based items or services with a rating of A or B in the recommendation of the U.S. Preventive Services Task Force or the Advisory Committee on Immunization Practices of the CDC with respect to the specific individual involved. It is important to note that plans must provide 100% coverage for these services, whether they were received in or out of network at this time. In addition, group health plans can now choose to cover certain services, although they're not required by either ACT or IRS guidance. It is now permitted for group health plans to cover all COVID-related expenses, even if the plan is a high-deductible health plan, without jeopardizing the participant's eligibility to make HSA contributions. Also, group health plans can cover all telemedicine services, not just those that are related to COVID-19 at 100%, even if it's a high-deductible health plan, because the CARES Act includes a provision that would ensure that those who receive free telemedicine services are still eligible to contribute to an HSA. Another note is that the CARES Act has expanded the definition of qualifying medical expenses for purposes of health FSAs, HSAs, HRAs, and Archer MSAs. So after December 31st, 2019, any amounts paid for over-the-counter medicines and drugs, as well as menstrual care products, are treated as medical expenses for HSAs, health flexible spending accounts, HRAs, and Archer MSAs. So, Paul, basically at this point, plans should make the appropriate amendments to their plans and work with their vendors and communicate these changes to participants as soon as possible.
Thanks, Jenny. It's Jeff. If you're a plan sponsor or administrator or fiduciary, can you expect some compliance extensions from the Department of Labor as a result of this pandemic?
Yes, at this point, the CARES Act expands the Department of Labor authority to postpone deadlines in the event of a public health emergency. Specifically, the CARES Act amended Section 518 of ERISA to permit the Labor Secretary to provide extensions of certain ERISA compliance deadlines in the event of a public health emergency declared by the Secretary of HHS. These extensions likely would be similar to the compliance extensions that have been authorized by the Labor Secretary in response to presidentially declared disasters, such as the hurricane and wildlife disasters. So ERISA plan sponsors, administrators, and fiduciaries need to watch for the Department of Labor guidance regarding compliance deadlines released in the coming weeks and months. Also, it should be noted that in addition to the extension to file federal income tax returns or payments that are due on April 15, 2020, individuals also will have an extension from April 15th to July 15th, 2020 for making 2019 IRA contributions, for paying the additional 10% tax owed with respect to early distributions from IRAs and retirement plans, for making 2019 retirement plan contributions, and for making 2019 HSA and Archer MSA contributions. However, employees who made excess deferrals to a retirement plan in 2019 are still required to take those excess deferrals and the related income out of the plan by April 15, 2020, in order to exclude the distributions from income. So at this point, this is the landscape with regard to extensions in response to COVID-19, but this also will continue to develop in the coming months.
Great. Thanks, Jenny. Let's turn now to workforce issues. We've got corporate and tax attorneys working on various types of loans, including some of which are forgivable loans. We've got labor and employment lawyers assisting clients with taking care of the workforce, and sometimes that means keeping them on, and sometimes that means furloughs and other items. We're really fortunate to have a labor and employment lawyer with us on this webinar who's been in the middle of much of this, Kevin Shaughnessy. So Kevin, what are the key elements of the CARES Act impacting workforces?
Well, thanks, Jeff. Some of the key elements have already been mentioned, and there's a few other benefits for employees that are available during this time, and most of these will be available through 12/31 of 2020. Those include a student loan repayment program for employees who have student loans, a foreclosure relief provision for employees impacted by the coronavirus crisis for some loans and mortgages, and some credit rating relief that's available in the Act. One of the things I really want to highlight, because there's a tremendous cost associated with agreeing to one of the benefits under the Act, is what happens if a larger employer, a mid-market employer between 500 and 10,000, would take advantage of the Treasury loans that are available under the CARES Act. If a company takes out a loan, the Act requires that the company must remain neutral in any effort by a union to organize its employees. In other words, an employer cannot campaign against the union. This obviously could severely inhibit a company's ability to avoid unionization. In fact, with a neutrality agreement, there would be no secret ballot election, and it's very possible that once the union gets 50% of the employees in a proposed bargaining unit to sign union authorization cards, they would have a sufficient majority to impose a union. That's a huge difference from the current NLRA law and the employer's right to bargain. Another aspect of the Treasury loan that's as egregious for those employers that are working with unions and have collective bargaining agreements is that the CARES Act Treasury loans abrogate certain aspects of the union agreement. Essentially, they will prevent employers from outsourcing or offshoring jobs during the length of the loan and for 2 years after the loan expires. This would certainly restrict the company's ability to subcontract work, and it would limit managers' rights significantly. In addition, in order to obtain a Treasury loan, a mid-sized business must certify that the funds from the loan will be used to retain at least 90% of its workforce at full compensation through September 30th of 2020. And they also must restore its workforce to not less than 90% of the workforce that existed on February 1st, 2020. Again, these are significant impositions on employers. I also want to highlight something that could be very beneficial for restaurants and hotels that are under NCIAS Code 72. The Act allows these employers seeking loans under the Paycheck Protection Program to deaggregate and to apply for loans based on the location of the restaurant or the hotel. And as long as the location has less than 500 or less employees, the restaurant, even if it's a 30,000 employee restaurant around the country, the restaurant can seek loans per location. The same applies to hotels. And that's a pretty significant benefit for two industries that have been gravely impacted by the Coronavirus Act. On the flip side, for venture capital firms, instead of de-aggregating, it's sort of as if they're aggregating on steroids, where the affiliation rules now drag in companies and entities that typically would not be considered part of a venture capital firm's portfolio. So that's something to keep in mind on the other side of the coin.
Thanks, Kevin. It's Paul here. So what is the interplay between the CARES Act and the Families First Act, and how do they impact a workforce differently?
Well, the main difference is that the Families First Act is focused on providing paid sick leave and paid family leave to current employees. And it expands rights under the Family Medical Leave Act and requires paid sick leave. CARES focuses on workforce retention for the existing employees and helping laid off or furloughed workers who are considered unemployed. They both have similar thresholds. They're slightly different, not important for our conversation here today. But one key difference is that under Family First Act, you must be employed and working in order to qualify for the paid leave benefits. You cannot be furloughed or laid off. On the other hand, the CARES Act is intended to help employees who have been furloughed or laid off. I want to just do one side note here on the healthcare industry. The Department of Labor just came out recently, in the last 3 days, with some new frequently asked questions or guidance on healthcare professionals, and they've expanded the definition of healthcare professionals far beyond what the Families First Act states. And basically, it includes almost every individual who's employed by a healthcare practice or a hospital. So that means that those entities do not have to provide Family First Act benefits to healthcare employees in their employ.
Thanks, Kevin. It's Jeff. As I mentioned earlier on the call, many of our clients are determining that these available loans, especially for medium-sized and large-sized businesses, just don't cover what they would need them to cover to keep their employees in place. Kevin mentioned the Paycheck Protection Program, which it is a forgivable loan program. It generally applies, though, to folks with companies with fewer than 500 employees. And as he said, in certain industries, you can disaggregate and check that number location by location. In other cases, that waiver is not available, and under the normal SBA guidelines, you have to aggregate companies, even unrelated companies owned by, for example, 51% by a venture capitalist or even by a couple VC funds if they exercise certain control. But Kevin, how will state laws impact the CARES unemployment compensation benefit? And do different laws work in unison if there are furloughs or other issues that employers are dealing with?
Well, Jeff, at the moment, to be honest, it's clear as mud, but we're hoping for guidance. Our best guess at this point is that the acts will work in unison. Typically, an employee will apply to the state for benefits, and once the employee qualifies for benefits, then the additional $600 per week under the CARES Act and the extension of benefits if the employee remains unemployed for more than 26 weeks would also kick in under the Federal CARES Act. The Federal CARES Act also greatly expands the number of individuals who are unemployed who can recover unemployment benefits. It expands it to individuals who are independent contractors, self-employed, and even individuals who quit one job and then intended to go work for another job, but that job fell through because the business was closed or temporarily shut down because of the Coronavirus Act. And each state's will enter into an agreement with the federal government setting forth the terms. And generally, we think that people will be considered unemployed, will still have to apply for work, but most states are going to do away with interview requirements, reporting into an unemployment agency, given the stay-at-home requirements of many states and localities, as well as the federal government's social distancing rules. So those things will change, but we hope that both the federal and state governments will work together on this issue.
So, Kevin, if a business is faced with this and has to reduce its workforce, tell us a little bit about what laws will apply and what pitfalls it should avoid.
All right, I'll be brief here, but there are a couple of very important laws. There is the Federal WARN Act that if you're conducting a mass layoff or a plant closure, you typically would be required to give a 60-day notice to the employees and to the local and state governments. Due to the exigent and unprecedented, unforeseen circumstances of the coronavirus, we anticipate that 60-day notice will be waived, but you still should provide as much notice to both the employees and the governmental entities. If you're seeking to get releases from employees who you're laying off and asking them to sign a release for severance packages provided to them, be sure that you follow the Older Workers Benefit Protection Act in order to get an effective release under the Age Discrimination Act. Essentially, you have to give the employee 45 days to consider the severance package and the release, 7 days to revoke the release once they sign it, and you must provide them with an exhibit showing all the individuals in the decisional unit who were retained, those who were laid off, and all of their ages. The other key requirement of the OWBPA is you must advise the employee to seek legal counsel to review the release. If you have a union, be sure to look at your union contracts because there might be bumping and recall rights that will restrict your ability to bring back certain employees. And finally, this is a big pitfall. Be sure you understand state laws with respect to what must be paid to an employee on his or her final day of work. Many states, California, Massachusetts, require that they must receive on the day they leave work, their last day, their final paycheck for all hours worked and some other benefits. So please be sure to check state laws.
Thanks, Kevin. It's Jeff. There are lots of companies that are remaining open, performing essential functions, many essential businesses, many folks in the security sector. What can we do to protect the spread of the virus if we're one of those companies?
Well, the CDC, local health authorities, and OSHA guidelines are being used by many employers that are still operating. And the EEOC and other agencies have come out with guidance on what questions can be asked. You are allowed to have your employees wash their hands before they start work. You can ask them questions such as, have you been in contact with anyone who's been diagnosed with COVID-19? Have you been in contact with someone who's traveled to a hotspot? And as of yesterday, hotspots include the states of New York, New Jersey, and Connecticut. So those are some things you can do coming into the door. You can send them home if they're symptomatic. You can prevent them from working if they're symptomatic, they have respiratory infections or a fever. These are things that you're allowed to do proactively in the workplace. The other thing that a lot of people are doing, and it's very practical, is they're trying to keep social distancing in the work. If you have 6 accountants, you spread them out in the workplace so they don't have to be within 6 feet of each other. If you work in different shifts, you don't cross-populate shifts. So if shift A has someone who tests positive on that shift for COVID-19, you might have to test and send home the coworkers who are within close proximity to that individual. But the shift B could step in because they didn't have anybody in their shift test positively. That you also can require the employee, if they do test positive, to provide notice to you, and then you can notify the other employees who might have been impacted or in contact, but you typically cannot release the employee's name for privacy reasons. There's a lot more I could suggest, but I know we're getting close to our time limit here. And Jeff, I'll turn it back to you.
Thanks, Kevin. And we do have time for some additional questions, and we've been receiving quite a few from our participants. Let me say a couple things before we get to those questions. First off, each of you who registered for this seminar will receive in writing our comprehensive tax alert that covers COVID-19, CARES Act, and related issues. So hopefully you were able to take some good notes on today's call. but to the extent you need something to refer back to, we've basically distilled to about 11 pages almost everything that was covered in this call today, and in fact, a bit more, especially quite a bit on the Paycheck Protection Program, and there's quite a lot of detail in that handout. In addition to that, we have a resource center that BakerHostetler has set up, a coronavirus COVID-19 resource center, where business lawyers, tax lawyers, labor and employment lawyers, and others have been posting really valuable insights as questions have been coming in from clients, and all of that is available to our clients and friends, and I would urge you to check our website for that. Our comprehensive alert that we're going to circulate to you in a PDF copy is also available there online. In addition to that resource center, over the last week, we've been fielding so many calls from clients that we've put together a task force. It includes tax lawyers, labor and employment lawyers, business lawyers, and others. And what they've been doing is getting on the phone with clients and doing a triage. Okay, here's the act. It's quite complicated. There's a lot of interacting provisions. What do you think might be available to you, and what do you think you might need to stay away from? Does something that looks like it might be a home run actually might it end up costing you much more if you go down that route than if you take another approach? So we've got task force members who are available to join our other lawyers and clients and friends on calls just to do a triage to say, look, there's a lot here. What should I be focusing on and what should I not be focusing on? And when you think about that as a seminar participant, it starts with, what's the size of your business? How many employees do you have? How are you owned? What industry are you in? What sector are you in? And then, if we have that information or you have it, we can very quickly start to narrow down what may be available to you to think about and what may not be on the table for your type of business or your size of business. If we can go to the next slide, I want to thank our speakers. They're here, and we'll leave this up as we take your additional questions. And we've got a lot of them. Many came in regarding the retention credit. And Michelle, let me ask you, for a business with more than 100 employees, is the retention credit still available on wages paid to employees working remotely who are providing only a portion of the services that they have traditionally performed?
Thanks, Jeff. Unfortunately, no. We are getting this question for a lot because a lot of our larger clients have folks working remotely in some capacity, even though it may be diminished due to decreasing demand or simply because their jobs don't allow them to completely provide all those services from a remote location. And unfortunately, if you are over 100 employees, you are not going to be able to take the retention credit on wages provided to those services who are providing services, even if they are reduced.
Thanks, Michelle. Kevin, I have two questions for you. A lot of our clients were looking at taking out loans and then retaining their workforce, and they're looking, at these very much enriched employee unemployment benefits that are available in the various states that the federal government is supplementing, both to accelerate the timing on which those are available and the amounts that folks are able to take home. So we've got a lot of questions in this category, and basically they are, does the CARES Act provide supplemental unemployment benefits for all unemployed individuals?
Our reading of the Act right now is that it does, but the state will likely determine that and then let the federal government issue the checks through the state to the individuals. So the $600 per week would be available. We don't have complete clarity on that at the moment, but that's our best view at this point.
Thanks, Kevin. And a lot of employees a lot of employers in the service sector are saying that many of their employees that might make more money if they're on unemployment than if they're coming to work. And we've gotten a lot of questions about this category, and that is, would an individual still employed but working reduced hours, in some cases even substantially reduced hours, qualify for that supplemental employment benefit, the enrichment that the federal government is applying to what the states normally offer?
At this point, our answer is yes. If reduced hours qualifies you for unemployment benefits or reduced unemployment benefits under state law, our reading is that the $600 under the CARES Act would also extend to those individuals.
Thank you, Kevin. And let me thank our chairman, Paul Schmidt, our speakers, Seth Hanft, John Lair, Michelle Hervey, Jenny Mills, Kevin Shaughnessy. This is Jeff Paravano, and we are out of time, but thank you so much for joining us. We will be following up and sending you some materials that hopefully you'll be able to find useful. Thanks, everyone.